Good afternoon, this is Coach Mike. Let's discuss our focus group charts and the focus group spreadsheet that I sent you all yesterday. You should have received it. If not, email coach@winningstockcoach.com and I'll make sure you do. Anyway, last week we kind of had some consolidation. It made some of our short-term trading, well, for lack of a better word, suck. Apple kind of beat me up a little bit. I know it beat up a couple other people, but we did have nice trades on Facebook, nice trade on Goldman Sachs, nice trade on Lockheed Martin, some things to pick us up with. So, that's kind of part of it. But because of that, it left me holding a strangle that I really didn't want to hold over the weekend, but I also didn't want to just be jumping into something else at the start of the week and get entrapped in that consolidation again. So let's talk about Apple. What I've got on there, I've got the 920, 9750 calls, and I'm personally in the 920, $100 calls. It just so happened it had slipped a little bit from where I planned that trade entry, and even though I'm going to hold that, and I probably won't buy this one, I do see the potential at a $100.15 target because it's really close to the $100, and that's the $100 strike. I think the 9750 calls are reasonably priced. If you get those before or before $94.90 for the stock price, I think you'll pay around $215. You'll want to use your low here, 93.28, as your stop. That could give you an estimated risk around 65 cents, but that estimated reward up to that target area of $100.15 could about double your money. So not the greatest risk to reward. It's really close to that 4-to-1 area, which is acceptable. And the other thing too I want to say is, if it were to fail that 93.28, I would have no doubt whatsoever you'd want to take the 920, $90 puts. So that's something too you could kind of look at if it were to fail that. Rather than dumping the calls right away, buy the puts for leverage. If you're already in that strangle with me, I think you're okay. And we'll see how it forms up in the first day or two of the upcoming week to see which side of that strangle we might hold. Caterpillar, CAT, you're going to want to start by looking at this on the weekly chart. We came down, we hit that weekly swing point. Last week was a strong week. I wish I would have gotten the trade that I had on last week's spreadsheet, but I didn't. Anyway, here looking at Caterpillar, I still think this has the potential to get back at least to the 110 area, and I wouldn't mind you taking October, not September, October 110 calls. I imagine you could get them about $1.15 if you bought them before the price hit $1.04. The problem is, and this is where you're going to have a little bit of conviction, is that swing point would be about $4 or $5 below where you could still buy this safely, and you'd still kind of have to hold and see if that held. That's the worst part of this trade, is there is a larger downside to it. So if you understand the downside and understand what that reward could be to, the potential up in this area, if it gets all the way up into the swing high, where I still think it could, would be that you'd see well over 150%, but that you could lose about 45 to 50% if it were to fail that swing point. So it might not be the perfect trade for everybody. That's the only trade I really see on Caterpillar. If I shift it over to the daily chart here, there is reason for me to believe that though it might go up just a tad more, it might give you a chance to buy this between 101.70 and 102. So if you're a little bit patient on it, let it go and see if it at least breaks that prior W, that prior swing high here. Then you could use these swing points from your daily chart kind of as support so you don't give anything up on the way down. CVX, I have this on the spreadsheet as no new trade. The reason is you see this trend line, and let me go back to a 1-year daily. You'll see it a little better since the last bottom. It held the trend line, held the trend line, held the trend line, failed the trend line. Even though it wouldn't surprise me to see it come back up above that trend line, I would also not be surprised to see it just retest it and pull back. I'd like to see what it does over the first few days of the week, because it may set up a bit of a puts play, but I don't want to convince myself of that just yet. But the sector in general, they all ran up really nice together. Got COP hit within pennies of my target area. XOM was dead on. CVX got real close, within $1.30. I wouldn't be surprised to see it make an up move that gave us a lower high. And then if the sector is still looking to trend downwards, we may use that as a potential short, but it's just not set up for that right now. Facebook, now I took a half position in the September 20th $80 calls off of the swing point here. You see this prior swing high from the prior high close. We held that through a whole week of consolidation and started to make a bit of a positive move, and then Friday was pretty just flat and dead. I'm not convinced yet I want to buy the other half of that position with my focus group account, but I know where my support and stop is. It's the gap fill from the earnings gap. Anyway, that's what I'm going to be watching, but Facebook has to show me it's not going to go sideways before I get in anything with Facebook. So let's be a little patient and let that establish itself as well. First Solar, when I sent out the update to the spreadsheet Wednesday night into Thursday, it gave us the W break. Right now it's just kind of Friday, it had dojied out. You're halfway between support and resistance. There's not enough room to even be talked about as a good strangle play. If you got in the play, you're safe in the W even for the retest. If you wanted to wait and see if it made the retest of the W so you could buy long up to the target, that would be fine. I don't see it as being that lucrative. I think if FSLR is going to continue, it's not going to retest the W until it hits the target. And therefore, if you're not in it already, you're probably better off to wait. And we talked about it in the chat room last week. Gold gave another entry within that horizontal channel. We've been talking about that for some time. It has popped above it and held it fairly nicely. Again, until it shows us otherwise, I would only look for opportunities for the strangle, as listed on the spreadsheet, when it's between this horizontal, the purple or pink lines, however you might be seeing them, between 122.50 and 125.50. And I'd be looking to strangle 122 puts and 126 calls, and 2 to 3 months out for each of those strangles, until it shows us something otherwise. Now, we have started making a pattern of higher lows here, and then should this hold up, I've just got it as a potential area I'm watching. But I think for right now, we're better off to just say, watch it anywhere within that horizontal channel for your chance to enter that strangle. GS, Goldman Sachs, this one had a big day on Friday, no doubt. We're in a swing on this that we picked up on Thursday. I still like it. Now, with that big of a day as what we saw on Friday, would I be surprised if it pulled back a little bit? No, not at all, I wouldn't. Would I be surprised if it continued? No, not at all, I wouldn't. What I want to watch for is that we don't give up all of that move. If we gave up half of it, a 50% retracement's perfectly reasonable. That would be to about 170. But I think we're kind of set up, and within a day or two, we may see some shorter term trades come off that 60-minute chart. But it ran so hard on Friday, you look at the intraday charts, it's pretty safe to assume that there's a chance that it could have a pullback. We have the up move. We need a down move so that we can determine a channel. Once you can have that, you can play between those channels on shorter term trades. Lockheed Martin, LMT, another one, filled the earnings gap, gave us an evening star, or a morning star, I'm sorry. Big day on Friday. So would I be surprised if it pulled back a little bit? No, not at all. It just had that huge candle. I like, though, on this morning star pattern, that our green candle completely made up for the red candle last Wednesday. It kind of X's this area out. I do think this has more high side potential. I do think it has the opportunity to give entries. I've got them listed on the spreadsheet. And whether it be the 170 calls, or even if you don't mind testing it, 175 calls, because I think we're going to get up to about 176 on this bounce move. So that's what I'd be looking at. Your stop would be this gap fill, which is a few bucks lower than where you are right now. But I would be looking for any down move that gives a higher low so we can identify a trend for the up move, at which time you could even take your swings and sell at the high of the trend, buy at the low of the trend, and bounce those back and forth so long as the trend gives that opportunity. If it's only making a 20-cent move on those, it's really not going to be worth it to pay your brokerage fees. If it's making a $50, $80 move with the options there, that'll be worth it to just flip all the way up to that 177. So that's what I'll be looking for with Lockheed Martin. UPS, this chart, it kind of failed what I wanted it to fail. I wanted it to hold this line. But I was watching it trade on Friday, and it really looked like it had some potential to the upside. The problem is, we did fail that support area I was looking at, which tells me that anything I'd play, I've got to play with 93.65, 93.63 stop, which I'm not really comfortable doing on UPS unless I played something out further, October, November, December. And also, too, I'm not so certain yet that UPS isn't just going to make a dead cat bounce on any up move. There's a reason they fell. If you take the time and read their financial report, it's not just about the EPS and they posted higher than they did last quarter. It's about some other things in there, their guidance, their fuel costs, a lot of things that made this stock fall. And then the last few days of the fall, well, that was the markets that made it fall. But it's one of those weird things where it's hard to explain. I do think this has a lot of high side potential. I do think this could get up to $100 probably fairly easy. But it'd be a very risky trade to make in my eyes. And finally, Visa. You see my Fibonacci extensions. Do I think Visa gets up to 225.65? No, but could it? Yes. MasterCard and American Express charts, they're set up beautifully for bounces. You'll see those in my general watch list video. And Visa could get some of that sector-based momentum. If I were to enter something in Visa personally, I'd be looking at that 50% line, that 216.93. I don't know that you'd even want to trade Visa for a $6 move. I wouldn't trade Visa, only anticipating a $6 move. But at this point in time, their earnings were bad. They fell on the earnings. Were they awful? No. Did they give no hope for the future? No. I think a lot of the bad stuff from their earnings came from how they were involved with the sanctions against Russia and how it did hurt them. MasterCard actually got a little bit of a whiplash from that as well. So Visa, it's the largest stock in the Dow Jones Industrial Average of those 30 stocks. If the Dow bounces, it's going to bounce, and sometimes it doesn't make sense where they go to. It'd be hard for me to assume it's going to hit that 225.65, but I wouldn't be surprised if it did. And if you don't mind spending a couple $100 a contract, the September 220 calls are going to run you about $1.95 to $2. But you got to have some conviction with that. You got to trade that according to your stop, not whether it's making a red or green candle. They're not going to move very fast at first, I don't think. You'd probably have to break that 216.93 before you started seeing something to cheer about. But you could end up potentially tripling your money based on if it were to hit that 225.65. Let's focus on the upcoming week. Let's be studying the charts, longer term and shorter term charts, if we do get continuation of this bounce, folks. Because of how we had that consolidation with like Apple and Facebook this past week, we don't want to get entrapped in that. And because there is the potential that the market could be bouncing from, the first real pullback we've had in several months, I don't really find myself focusing on short-term trades at a time where it's best to trade long-term stuff. So, we might be looking more for the focus group counts right away for the first few days if we get the continuation to get established in some longer-term stuff. As we start to enter towards the tops of that area, when we get into those consolidation points, that's where we look for that shorter-term stuff. So that's what I'll be looking at. If you have any questions, I'll be in chat Monday and Tuesday. I did want to inform you, I sent an email out about my grandfather passing away. His funeral service is Wednesday at 11 a.m. Eastern Time, and they're doing the calling hours Tuesday evening from 5 to 8. That is going to cause me to cancel my weekly webinar for the first time in a long time. This week we're not going to do the Tuesday night class. I don't know yet if I'll make it up another night. We might just miss it since it's summertime and I haven't really missed any. And Wednesday, I will more than likely not be in the chat room all day long. So it doesn't mean the chat room will be closed. We've got great moderators. We've got people there to help you all out. But it just means that Coach Mike might not be there, or if he gets there, it'd be really late in the day. So best of luck this week. Let's use the chat room for what it's intended to. Let's be focusing on these charts, studying these charts, and really putting our minds together for some quality trades. There's no reason to sit there just being silent, waiting for somebody to tell you what to trade. Engage your charts and engage the chat room.